Now let's look at one more example relating to the price of a bond when both income tax as well as capital gain tax are present on the bond. Now we are talking about a scenario where a 20-year fixed interest bond is issued with a coupon of 6% per annum payable semi-annual. So basically it's like, because it's a 6% per annum, I assume, let's say the face value of the bond is 100. So per year 6 is the coupon that is paid, means semi-annual, every half year 3 rupees is the coupon that is getting paid. And the bond is redeemable at 120% at the maturity date. So after 20 years, the same bond can be sold at 120 rupees. So an investor who pays both income tax as well as capital gain tax of 30% per year purchase the bond on the date of issue, and the investor's net yield was around 8%. So basically the present value of the bond, the price is nothing but the present value of the future cash flows. So what are the cash flows? If there were no taxes, it would have been 6 per year for a period of 20 years. So it is 6 8 20, but on a semi-annual basis. So it would have been 6 8 20 on a semi-annual. These are the coupons, and the principal, let's say it is 120, which is going to come after 20 years. So V power 20. This would have been at the rate of 8%. This would have been at the rate of 8%. So initially let's consider the scenario when no taxes were there. When no taxes were there, what was the price the investor was willing to purchase this bond? This is the price. So the price at which he is willing to purchase the bond, if the taxes were not there, is 6 times, okay, A220, I can write it as A20 into I by I2 at the rate of 8% plus 120 V per 20 at the rate of 8%. So probably from the actuarial tables, I can try finding out the values of I2 and all at the rate of 8%. At the rate of 8%, I will get my A20 at the rate of 8% is 9.8181. Okay, 6 into 9.8181, and I, we know that it is 0.08, whereas I2 comes out to 7.8461%, and I can find out V20, V par 20, which can give me the V par 20 can directly give me the final computed price of this bond. So I'll take this price of the bond is equal to 6 times 9.8181 times 0.08 divided by 7.8461%. That's the first part. That's the first part, and the second part is 120 V per 20. So I will, to this particular number, I will add 120 V. V is 1 by 1 plus I. So I can say 120 divided by 1 plus I is 8% to the power 20. So this is working out to somewhere around, had the taxes not been there, the price of this bond would have been 85 rupees 81 paisa for this same bond, which is going to be redeemable at 120% of the maturity value after 20 years. The price of this bond, the no arbitrage price, the better price for this bond would have been 85. But because of the presence of taxes of 30%, now what is happening is this 6, whichever is coming per year, it is subjected to a 30% tax. So obviously what is coming out is only 70% of this 6. The rest all remains the same. 822, this part is the same at the rate of 8%, and this 120, which is the capital, remains the same. But out of this there is an excess, 120 minus P, whatever is the case, the purchase price and the redemption price. The difference between this is subjected to a capital gain tax of 30%. But this is something that is applicable after 20 years. So the present value of that, I will take it as V power 20 itself. So this is what is an updated calculation that is going to come up. So obviously my equation will become 4.2 times 822 plus 120 V power 20 minus 120 into 0.3, which is 36. Now 36 V power 20, and this becomes plus 0.3 P V power 20. So here this side we have P. So probably bringing all P's together, P into 1 minus 0.3 V per 20 is equal to 4.2 822 plus 120 minus 36, 84 V per 20. So from here I can talk about the purchase price now is 4.2820 on a semi-annual payment basis plus 84 V per 20. This entire thing I am dividing by 1 minus 0.3 V per 20. Now this will give me the price in case there is a corporate gain tax as well as income tax present on the bond. So through this mechanism, let's try to find out. Okay, I is 8%, right? Let me work it out. I is 8%. So V will be 1 divided by 1 plus I. So V is 0.92. Okay. 8. I2 also I require. I2 is nothing but 2 times 1 plus I to the power half minus 1. So this entire thing gets. So this is the value of I2. I2 working out to 7.85%. Then I have 820. 820 I could have picked directly from the actuarial tables. 9.8181. Right, so this is my 820. Then V power 20 is one more thing which I require. So this is my V to the power 20. That's the number. That's it. Now from here I'll try to find out what is my P. 4.2 times 820 to 820 into I by I2. I by I2. This is the first part. Right, let me put this entire thing under bracket. This is the first part. Then I have 84 V power 20. This is the second part. This entire number I am dividing by 1 minus zero point 0.3 V power 20. So doing this will give me that the price is only 64.2. If this much of taxes are present, if this much of taxes are present, 30% is the tax rate both on capital gain as well as the interest. The person is willing to pay. The present value of the future cash flows is going to be only 64.2 rupees, not 85.81. So when the taxes were not there, probably the investor was willing to buy this bond at 85.81, but with the presence of taxes, this cannot be bought for more than 64.2. That is how the prices will vary in case the taxes are present on the particular bond. The presence of both income taxes as well as capital gains taxes would reduce the price that need to be paid for purchasing that bond. Alright.